UnitedHealth Group just reported its Q1 2026 earnings today, and the stock is absolutely surging, up nearly 9% as we speak. If you have been watching this one from the sidelines, now is the time to pay very close attention. I am going to break down the massive earnings beat, the new valuation metrics, what Wall Street is saying, and my fair value take. Let's dive in. UnitedHealth Group just reported Q1 revenue of $111.7 billion, with an adjusted EPS of 7.23. That didn't just beat the Wall Street consensus of 6.61, it crushed it. This is the widest earnings beat the company has posted in 5 years. But the real fuel for this rally came from the government. The Centers for Medicare and Medicaid Services finalized a 2.48% rate increase for Medicare Advantage plans for 2027. This is a massive pivot from the flat 0.09% hike initially proposed in January. This adjustment alone injects over $13 billion into the program, giving UNH a much clearer runway for growth. On top of that, Morgan Stanley just named UnitedHealth a top pick, and the company confirmed plans to repurchase at least $2 billion of its own stock by the end of June. Now let's look at the numbers. Even with today's jump to roughly $346, the valuation still looks compelling. First, the company raised its full year 2026 adjusted EPS guidance to over 18.25. Based on that, the forward PE ratio sits around 19x. For context, UNH's 5-year historical average is roughly 25x. Next, look at the price-to-book ratio. It's currently between 2.84 and 3.23, which is significantly lower than its 10-year median of 4.92. When we look at intrinsic value, the alpha spread DCF model places UNH at $406, suggesting it's still undervalued by about 24%. Some models, like Simply Wall SD, project a fair value even higher based on long-term cash flows. Wall Street is leaning heavily into the strong buy camp. Bernstein raised their price target to $411, while Truist and Jefferies are targeting the $370 to $373 range. Across 23 analysts, the consensus average sits at $366. However, keep an eye on the risks. Regulatory scrutiny on Medicare Advantage remains a factor, and the integration of Optum's various arms continues to bring high costs. But with the medical cost ratio improving to 83.9%, down 90 basis points year over year, the cost pressures that hurt the stock in 2025 are clearly easing. Here is the bottom line. UNH came out of a brutal 2025 battered and discounted. Today's results confirm the recovery is in full swing. With a PE still below historical norms and a raised outlook, this stock likely has more room to run. This isn't investment advice, so always do your own homework. If you want to keep tracking fair value analysis on stocks like UNH, hit subscribe and ring that bell. I will see you in the next video. Thanks for watching. Disclaimer: this video is for educational and informational purposes only and does not constitute financial advice.